Hello, this video is all about the debit and credit visual notes. And first up, we have T accounts. Then we're going to go over some questions for analyzing. Then we're going to go over 10 example transactions with tips and review along the way. So let's jump right into page number 1 with T accounts. Okay, so at this point, we know that assets equal liabilities plus owner's equity. We know that is the accounting equation. We know that account is defined as a record summarizing all the information pertaining to a single item in the accounting equation. Now, a T account is an accounting device used to analyze these transactions. And we know that the accounting equation must always be in balance, and the T account is going to help us ensure that it is. The normal balance is the side of the account that is increased. The debit side is an amount recorded on the left side of a T account, and the credit is an amount recorded on the right side of a T account. Now, lots of times when people start to learn accounting, they get confused about debit and credit because they think debit card, credit card, but that is not at all what it means in accounting. Debit means left, credit means right, and it's as easy as that. So debit is left, credit is right. So we know that assets equals liabilities plus owner's equity. And you'll see that the accounting equation is its own gigantic T account. So you'll see the top of the T is the accounting equation there. And then the vertical part of the T is the equal sign. And then under each side, you'll see that the individual accounts can also be represented by the T accounts. So over on the left side, on the debit side, you'll see assets. They all work the same way. So supplies, insurance, cash, accounts receivable, they are all represented in the same way. So we have debits on the left, credits on the right, and then the normal balance side is the side that's increasing. So for all assets, the normal balance side is the debit. And it makes sense if you think of it as assets are on the debit side of the overall accounting equation, and they increase on the debit side because they're on the debit side. Then on the credit side of the accounting equation, we have liabilities, and those are represented by accounts payable accounts. And all of those work the same way. Debits on the left, credits on the right. Normal balance is on the right, aka the credit side. And if you think about it, liabilities are on the overall credit side of the accounting equation. Their normal balance is credit. So under owner's equity, we have the same thing as far as debits on the left, credits on the right, and the normal balance is on the credit side. Again, owner's equity is on the overall credit side of the accounting equation, and it increases on the credit side. And so if you think about overall owner's equity, some of these 4 situations seen below here, some of those things increase overall owner's equity and some of them decrease overall owner's equity. So think about if the business is smiling or frowning. If somebody puts money into the business as an investment, the business is smiling. Same thing with revenue. When money comes in from sales, the business is smiling. Those 2 things increase overall owner's equity. They are on the credit side. On the other hand, if the business has to pay expenses such as rent or postage or advertising, the business is frowning. Same thing with a withdrawal. When an owner takes money out for personal use, the owner might be smiling, but the business not so much. So expenses and withdrawal, the overall business is frowning, which means it is a debit to an owner's equity account. So there you go. Assets equal liabilities plus owner's equity. Debits are always on the left. Credits are always on the right. The normal balance side represents which side of the account is increasing. And for assets, they increase on the left, on the debit side, because they're on the overall debit side. For liabilities and owner's equity, they increase on the credit side because it is on the overall credit side of the accounting equation. Moving on to page 2, we're going to go over some questions for analyzing. So at the top of page 2, we have the chart of accounts, and the chart of accounts is defined as a list of accounts used by a business. You'll see it's separated by balance sheet accounts and income statement accounts. It's separated by categories of the accounting equation. We've got assets, liabilities, and owner's equity. We also have more owner's equity accounts in terms of revenue and expenses off to the right. That is a place that you can go to look to see account titles and how they're classified. Questions for analyzing transactions. The first one you want to ask yourself is which accounts are affected? And there's going to be key words in each one of the transactions that helps us figure that out. So which accounts are affected? You can see the chart of accounts for a list, and those account titles are what you will use. Then the second question is, how is each account classified? Now, this means, is it an asset, liability, or owner's equity? And that's important because that's going to help us figure out if it's a debit or credit. Number 3 is, how is each changed? So this is asking, is it an increase or a decrease? And again, that plays into debits and credits. Number 4, how is each entered? The answers to the above questions are going to help us figure out if it's a debit or credit. And remember that for every transaction, debits must equal credits and the accounting equation must be in balance. So let's try an example. Transaction number 1 says that on April 1st, we received cash from the owner as an investment, and it was $2,000. You can see our images there that remind us what we've previously learned about. And then under each transaction, we have those 4 questions to analyze transactions. So number 1, which accounts are affected? You'll see the bold underlined words help us figure out which accounts are affected. So the first one, of course, is cash. It says cash right in the transaction. So cash is affected. Question number 2, how is each account classified? That means, is it an asset, liability, or owner's equity? And cash we know is an asset. It's something of value. Question number 3, how is it changed? Well, received cash, that means it increased. And then how is it entered? We know cash, as all assets do, increases on the debit side or the left side. So it is entered as a debit. So you'll see our little T account there. We have cash along the top. We know the normal balance side is the debit, and we know we're increasing it $2,000. Okay, on the other side, we see that we received cash from owner as an investment. We know investment affects owner capital, so we've got D-owner capital. And if you don't know what that is, look up in the chart of accounts so you know that the owner's name is correct. Question number 2, how is it classified? Well, it's owner's equity. And remember, is the business smiling or frowning? More about this on page 4, but owner's equity, the business is smiling, it's getting more money. How is it changed? Well, it's increasing. Owner's equity goes up when an investment is made. And then how is it entered? We know that owner's equity accounts increase on the credit side. So it is a credit. And our T account there, we have DO capital. It increases on the credit side, and we know it's $2,000. So debits and credits both equal $2,000. We're increasing on the debit side of the overall accounting equation. We're increasing on the credit side of the overall accounting equation. So our accounting equation is in balance, and our debits and credits are equal. Moving on to more example transactions on pages 3, 4, 5, and 6. There will also be tips and review along the way. So on page 3, we move on to transaction number 2. And on April 2nd, we paid cash for supplies, $300. So we've got our repeat images there. So we know cash and supplies are affected. So let's start with cash. How is it classified? Well, we know cash is something of value. It is an asset. How is it changed? It is decreasing. If we pay cash, that means our cash is decreasing, and it is entered as a credit. So we've got our T account there. Cash goes along the top. We know that it increases on the debit side. It decreases on the credit side. And in this case, it's decreasing by $300. Our other account, like we said, is supplies. It is also an asset. It's something of value. It is increasing. We are paying cash for supplies. So we're getting supplies, and that is entered as a debit. So we have supplies at the top of our T account. We know that it increases on the debit side, as all assets do, and it is $300. So our debits and credits match. And because we decreased and increased on the same side of the accounting equation, it is still in balance. And just as a reminder, in the middle here, it says transactions can either increase on both sides, decrease on both sides, or like transaction number 2, increase and decrease on the same side of the accounting equation. Okay, transaction number 3. On April 4th, we paid cash for insurance. Now, We're going to pause and see if you can fill out this table and the T accounts. Just a little tip first, it is very similar to transaction number 2 where we paid cash for supplies. So go ahead and pause and see if you can fill it out. Okay, so now let's see if you're right. Which accounts are affected? Cash, it is an asset, it is decreasing, and it is a credit. So our T account looks like that. For insurance, did you get prepaid insurance? If you just wrote insurance, that is not one of our account titles. How do we know this? Well, we looked at our chart of accounts, and under assets, it says prepaid insurance, not just insurance. So don't forget about checking your account titles in your chart of accounts. Okay, so prepaid insurance, an asset, it is increased, and so it is a debit. And our T account looks like this. So we are increasing and decreasing on the same side of the accounting equation, which means we're still in balance, and our debits and credits match. They're both $600. So check, check. Here we are with transaction number 4 on page 4. And on April 7th, we bought supplies on account from vendor for $800. So we bought supplies on account. Let's start with supplies. How is it classified? Supplies is an asset, and we're buying supplies, so it's increasing, and it is entered as a debit, as all assets are when they increase. And our T account up at the top looks like this. Supplies increases on the debit side of $800. Our second account is on account from vendor. That means we bought supplies, but we have not yet paid for them. So we have a bill that we're going to have to pay. It's an account called accounts payable vendor, and it is classified as a liability. It's something we owe. Now, when we buy supplies on account, but we don't pay for them yet, our bill increases. So our liability goes up, and we know that liabilities are on the overall credit side of the accounting equation, so it is entered as a credit when it increases. So we've got our abbreviated account title there, and we know it's increasing, and it's on the credit side. So we're increasing on both sides of the accounting equation. One is a debit, one is a credit. That looks good. Okay, transaction number 5, we're paying cash on account to vendor for $500. So we bought supplies on April 7th, and now we're going to pay for part of that bill. So number 1, which accounts are affected? Well, it tells us we paid cash. So cash is our first account. It is, of course, an asset. We're paying cash, so it's decreasing, and it is entered as a credit. So all assets decrease on the credit side. Our T account looks like that. And just like in transaction number 4, our account title for our bill that we owe vendor is called accounts payable vendor. It is classified as a liability, as we learned in transaction number 4. And now our bill is going down. So we're paying on our bill. So it is decreasing, and it is decreasing on the debit side because all liabilities decrease on the debit side. Our T account looks like this. We're decreasing on both sides of the accounting equation. Both the debit and the credit are $500, so both of those look good. Okay, down at the bottom of the page here, we have 4 different transactions that affect owner's equity. So the first one, see if you can guess, represents money being put into the business. Do you remember what that little picture represents? Money being put into the business, that's an investment. And we know that when the business is smiling, it increases on the credit side because owner's equity is on the overall credit side of the accounting equation. Now, what's the next one that has the business smiling? This one represents money coming in from business operations. This account is sales. If you said revenue, you're not far off. Revenue means the same thing, but sales is the account title that we use for revenue, and it increases again on the credit side. You'll see the check mark on the right to represent the credit side. Below that, we have the business frowning. So which one represents the owner taking money out for personal use? Do you remember what that little symbol means? That is withdrawal. And we know that the business is not happy when the owner takes money out for personal use. So the business is frowning, and that means that it's going to decrease overall owner's equity, which means it will be a debit. So the normal balance side of an account called owner drawing, which represents withdrawal, The normal balance side is a debit. But if you think about overall owner's equity, it makes sense that it would be a debit because it's decreasing overall owner's equity. Similarly, we have expenses that represent money going out as a result of business operations. The business is also not happy when it has to pay for things like rent and utilities and postage and advertising and all kinds of other things. So that is, again, on the debit side. So we've got our little tips on the side there. Owner's equity tip, smiling business equals credit side. Frowning business equals debit side. And overall owner's equity decreases on the debit side and increases on the credit side. So keep those in mind for a better understanding of owner's equity. Here we are at page 5, transaction number 6. On April 15th, we received cash from sales. It was $300. So which accounts are affected? They are keywords in the transaction itself. The first one is cash. We know it's an asset. When we receive cash, it increases and it is entered then as a debit because all assets increase on the debit side. So our T account looks like this. And then on the other side, we have sales, which is classified as owner's equity, and the business is smiling. The business is happy when sales are made. And so it is an increase and it is entered as a credit because when overall owner's equity increases, it is on the credit side. So our T account looks like this, and we'll see that we're increasing on both sides of the accounting equation and that we have a debit and a credit of $300, so debits match credits. Transaction number 7. On August 16th, we sold services on account to K customer for $500. And so which accounts are affected? Well, the first one, it says we sold services. That represents a sale. So we put that into sales. And just like the previous transaction, we know sales is classified as owner's equity and it makes the business smile. So sales increases and it is entered as a credit because when overall owner's equity goes up, it is a credit. It's on the overall credit side of the accounting equation. So we have our little T account, sales, we have an increase of $500. On the other side, we have sold services on account. That means they have not paid us yet. And so we send a bill to them or we give them a bill. So it is accounts receivable. It's something of value to us that we are going to receive, but we have not yet received the cash for it. So something of value, it's an asset. How has it changed? Well, their bill goes up. They bought something for us, so their bill increases and it is entered as a debit because all assets increase on the debit side. So now we have accounts receivable, K customer, we've abbreviated it there, and we know it increases on the debit side for $500. So assets, sales, opposite sides of the accounting equation, both increasing. That's good. That means that we are in balance and they have a debit and a credit of $500, which means that our debits and credits are equal as well. Transaction number 8, we are paying cash for rent and it's $600. So let our keywords guide us. Cash is the account that's affected. It's an asset. We're paying cash, so it's decreasing, which means it is a credit. So our T account looks like this. And on the other side, our account title is rent expense. Don't forget to write the word expense after that. And it is classified as owner's equity, but now the business is frowning because it's not happy that it has to pay rent. So it is an increase to our expense account, but our overall owner's equity decreases. This gets a little bit confusing, but think about it in terms of business smiling or frowning. So how is it entered? Well, it is a debit. And a little trick here, if you get caught up on that, but you know for sure that cash was entered correctly, you know for sure that when cash decreases, it is a credit, then the other account that's affected has to be a debit. So our T account looks like this. Okay, last page, page 6, transaction 9. On April 26th, we received cash on account from K customer for $300. So which accounts are affected? Well, cash. We know cash is an asset. How is it changed? We received cash, so it increases. And how is it entered? Well, it is increasing, so it's a debit. So our T account looks like this. We're increasing on the debit side. And our other account is the accounts receivable account for a customer. It is also classified as an asset. And now that they're paying on their bill is decreasing. So it is entered as a credit. So our T account looks like this, and we are increasing and decreasing on the same side of the accounting equation. So our accounting equation is in balance, and we have a debit and a credit of 300. Okay, our last transaction number 10. On April 29th, we paid cash to the owner for personal use. We paid $100. So which accounts are affected? Cash, of course, is an asset. It is decreasing because we're paying cash, and we know that's a credit. Our T account looks like this. Our other account is owner drawing. And so if you don't remember the owner's name, remember to go back to your chart of accounts. And our owner's name is Diona, and it is an owner's equity account. And when the owner takes money out for personal use, the business is not happy about it. The business is frowning. And so how is it changed? Well, drawing increases, but overall owner's equity decreases. So it is a debit. Now, this gets a little bit confusing. Let's look at our T account here. The owner drawing account increases on the debit side. However, overall owner's equity is decreasing. So we know it's a debit. Remember to use what you're sure about for the other account to guide you if you're not sure. So we know cash for sure is a credit. It's decreasing. We know that for sure. Then the drawing account has to be a debit. Use what you know for sure and the little tips to help you out as you go. Okay, down on the bottom, we have a review of our accounting equation. Of course, assets equal liabilities plus owner's equity. And then we have all those repeat symbols. And we're going to go ahead and pause right here. See if you can fill in what all those symbols mean. Did you get it? Our assets, of course, are cash, accounts receivable, supplies, and insurance. Our liabilities all start with the words accounts payable, and then it's specific to whoever we bought something from and haven't yet paid. And then under owner's equity, we have the investment, which is something that the business is happy about. Also revenue, something that the business is happy about. Those are both on the credit sides. And then expenses and withdraw. You see the frowny faces. That means they are on the debit side. So now we have a better understanding of debits and credits. Lots more examples to come. Thanks for watching.